Good afternoon, and thanks for joining us today. My name is Corey Pierce, and I'm the Marketing Director here at Churn Zero, and I'd like to I'd like to welcome you to our webinar titled B2B SaaS Benchmarks, How Does Your Company Compare to Over 1,500 of its Peers? Before we get started, I'd like to remind you that we are recording this session, and we will be sending out a link to the recording tomorrow of this webinar. Throughout the presentation, you're welcome to submit your questions via the questions tab, and our staff will try and answer them as we go. We'll also address as many questions as we can during the Q&A portion of this webinar. Now, I'm pleased to introduce our two speakers today. We have Rob Belcher, who is the Managing Director of SaaS Capital, which is a leading growth debt provider for SaaS companies. And we also have Yuman Zhang, who's the founder and CEO of Churn Zero, which is a real-time customer success platform. With that, I'll turn it over to you, Yuman, to get us started.
Yeah, thanks, Corey. And hey, Rob, thanks for doing this again. This is what, our third year? Is that right?
I think so. Yeah, it's great. It's always fun. Yep. We have a lot to share between us.
Yeah, it's been it's been kind of a nutty year, and actually I imagine, like, for SaaS it's really been kind of a crazy decade, right? So it's really fantastic to see the benchmarks. So what I want to do is just,
I've got a slide that shows sort of back over a decade too, so we'll show that exact growth that you're talking about.
Yeah, that's great. So why don't we do this? Why don't we? You have a lot of data to share, benchmarks to share, and I'm just going to hit you up with questions along the way. And the audience, if you have any questions for Rob as we go along, we want to try to make this a bit interactive. So just go ahead and put in the questions part. So Rob, go ahead and get started. Hit us with some data, and we can get going.
Yeah, it's been a crazy year. You can see from that picture that it's been a while since I've gotten a haircut. The COVID haircut. So it's been a year. But that's kind of the point of the talk today, is actually focusing on data as it relates to the COVID impact from last year. So we do a survey every year out to our network and our community that asks questions around typical SaaS metrics: growth rate, ARR, retention rates, ACV, things like that. And then we use that data to share, just like this, benchmarking reports and webinars throughout the year back to you all, so you can see how you compare to your peers. And this year we focused a lot of the questions on COVID impacts. And this is our 10th annual, which was kind of surprising, came out of nowhere, but it's been our 10th year. We had over 1,500 people respond this year, largest ever, and we assume it's the largest survey of private SaaS company data out there. And so happy and excited to share that data with you.
That's great. Now, hey, Rob, so when you first did this, any idea how many respondents you had? I mean, it's always good to see the growth.
Yeah, that's a good question. It started off with sort of our LinkedIn network. So I think it was around 200 people responded initially. And then as it's sort of our brand name and our company has grown, the survey's grown over time too. We had about 100 to 200 every year. I think last year we actually had, I think, 16 and change this year. We said over 1,500 because it's a nice round number. And the year before it was 14 and change. So about 200 every year of new. And it's not necessarily always the same companies, but a lot of them do repeat year after year.
I imagine it has to do a lot with just how SaaS is growing as well, right? Your survey respondents.
Yeah, I think you and I both can confirm that software has been a bright spot in the economy over the last 10 years, and it's easier than ever to start a software company, right? That is the SaaS model, and so there are a lot of them. And one of the questions we ask is, if you're founded, there's plenty of companies in the survey that were founded in 1998 and 2002 and things like that, but a lot that are 2016, right? That were founded since we started doing the survey itself. So you're right. In the survey and for the data today, we focus on revenue retention. There are lots and lots of other ways to measure retention, and all of them have value and are important. And you may have a specific one to your industry or something like that, and that's great. We are lenders. We lend money to software companies, and we both lend based on the size of your revenue, and then we hope to get repaid eventually out of your revenue. So that's a big focus for ours, both in underwriting and sort of our business model. And then also, and we'll talk a lot about valuation at the end here, but SaaS companies are valued based on revenue, right? They're not based on profitability or EBITDA or earnings or anything like that. They're typically, the shorthand is a multiple times ARR, annual recurring revenue. So revenue is the name of the game to create value. So we focus on net revenue retention and gross revenue retention are the two main metrics for today. And in the survey, the formula that we ask survey respondents to use to determine it is a year-over-year cohort analysis. And for net, that means, what was your revenue last year? Call it April of 2020. And then let's look at just those customers you had in April 2020, and let's see what they did for you in revenue this year. And then we will subtract out any contractions of the customer base, any full-on lost churns, and then we can add back expansions, price increases, upsells, cross-sells for net retention. You divide those things together and you get your net retention. That can be anything. Your expansions can far exceed your losses, and so it could be well over 100. Gross retention is the same thing, but no expansion revenue included. And so the most that one can be is 100%. That can't, the best you can do is retain everybody and not count any expansions, and so you can get to 100. So those are the two main things we're talking about today. I think we start off here with a simple benchmark of both of those metrics spread by ARR. So blue is net retention, green is gross retention, and my two big takeaways here is that first off, the median is around 100% for net retention and around 90%, a little higher. We'll talk more about that in a second for gross retention, but the shapes of those are very different, right? Net retention is pretty flat through a company's growth from basically 0 to public, if you will, around 100. But gross retention, you can see clearly declines as companies grow. And it settles in at that sort of 90% range, which is we've seen historically the typical median. My last comment on this one, and I normally breeze right over it and don't even acknowledge it, but this is like year 5 of seeing the same data reaction, and I don't have a great explanation for it, but year on year on year in our survey data, we've seen this weird dip, particularly in net retention, but sometimes also in gross retention in the 5 to 10 million ARR bucket. And like I said, normally I would just chalk it up to noise, but having seen it consistently for so many years, I'm going to mention it quickly. And I don't have a great reason for it. Maybe a company gets to a certain scale, and Yuman, you might have some thoughts here. They get to a certain scale and they start experimenting with pricing and packaging. They change the org structure and move CS into sales or out of sales or who knows what before kind of getting things back to that 100% range once they get to 10 million of ARR.
Yeah, that's a good point, Rob. So that $5 to $10 million range, as an entrepreneur, I know that's a really dangerous time. And between 5 and 10, you sort of move from being a company where it's basically the founders and the founding team doing heroic things to get to 5, but to get to 10, that's really where process has to take over. Scalability has to take over, and that shift from 5 to 10, from individual heroism to scalability, I think has always been a hard problem, and so that may explain it. Now, you and I talk about this chart all the time, and this chart has always confused me a little bit, but you have the numbers and they're consistent, so I'm going to have to slowly believe it. But I've always made the assumption that the bigger your company, the more tenured your base is, therefore generally retention revenue go up, right? Because it's year 1 and year 2 when people are trying you for the first time. That's when they're in most danger, right? And so if you are smaller, you should probably have more year 1 type of clients and fewer tenured clients. And as you get bigger and bigger, that mix starts to change. Any thoughts on that, thesis I have and why it doesn't reflect in that data?
Yeah, I think it's a great point, and intuition agrees, I think. But something we've thought about, and we've seen it because oftentimes we'll talk to companies. Our minimum revenue threshold to lend money to a company is 3 million of revenue. So we talk to lots of 1 to 3 million companies that are a little too early, and frequently they have really strong retention. And then by the time a year later or so, when we're able to underwrite with them and partner with them, retention actually drops. So it sort of verifies the data. But also talking to them anecdotally, we think what's happening is just there hasn't been time yet for customers to churn, particularly if you're doing 2-year, especially 1-year, 2-year, 3-year deals. They just haven't had a chance to renew yet or to churn. And so over time, you have sort of inflated retention early on before you get to see your true life cycle. You haven't even gone through a full life cycle yet. By the time it takes to get to 2 million of revenue or so. That's the thought.
That's fair enough. I think that's a great explanation.
Okay. Great. And so, as I mentioned, this is a historic chart. This is actually a chart from last year. And I wanted to show this because we're going to start here and then we're going to talk about COVID impacts from the 2020. So this is actually at the end of 2019. And like I said, median of 100 for net retention, median for 90 for gross retention, but wanted to spread this by ACV. We think annual contract value is a better way to look at retention benchmarks because, scale is nice and important. And like we talked about, a lot of companies go through a lot of the same things about 5 million of revenue. But really, when you get down to it, operationally and structurally, the way companies are organized and the way they operate around contracts and around customers, they have more in common there than they do in just scale, right? Whether you're selling to thousands of customers, it's sort of $1,000 a month, or you're selling to 10 customers at several $100,000 a month. That just is a big difference. So we split it this way, and this is almost kind of the opposite of that ARR chart, where we see that there's a direct correlation between ACV and net retention, where net retention increases with the size of contract. And then on gross retention, it's actually pretty flat across all ACVs with a little bit of a skew at the very high end and the very low end. And I think that kind of makes sense, right? Higher ACV, you're more white glove service, probably doing definitely quarterly review calls, but probably monthly, even weekly calls with customers, more professional services. You're just more ingrained and just more opportunities to upsell. And at the lower end, the opposite is true. And then with gross, though, there's sort of, as we showed, there's, sort of baseline customer level, SaaS subscription level retention, and that's where that sits. So that's last year. Let's get into, this is net revenue retention for this year. And we actually asked this same question, but we asked for 3 data points: beginning of the year last year, middle, and end of the year. And this is those same ACVs. Dark blue is January, green is June, light blue is December of last year. And this is net revenue retention. And my big takeaway here is it's a pretty noisy chart, and I don't see a lot. There's maybe a percentage point, 0.5%, that you could argue there's a drop between January and the middle of the year. We have this one group that actually has increased middle of the year retention. So I'm just not seeing a lot. It looks noisy. And I think what's happening here, and we saw this in our own portfolio, and there'll be some anecdotes that both Yuman and I will share here, but this is across every company in the survey, but it's split by ACV, which is a useful thing. We'll actually split it by a couple other things later on to try and tease this out. But I think what we're seeing is a wash between companies that actually benefited from the pandemic and those who were negatively impacted, right? There are certainly companies out there, telehealth, e-commerce, other healthcare things, right, that benefited from the situation. And then certainly there were lots of companies that were negatively impacted. And so I wonder if that's what we're seeing, especially on NRR, right, where the companies that had the tailwinds were probably upselling significantly. And so that's overshadowing the negative impacts from the companies that were hindered by the economic shutdowns and things like that. So let's go to gross retention. You say, go ahead.
Yeah, no, I think you're right. I mean, I think because you will go talk about gross, but on net,
yeah.
I think verticals by verticals, there's a wash, as you imagine, and winners, and if you have a mixed customer base, your winners will mix with those who were suffering, and you're most likely the same. Also, what I have found a lot is, the COVID freeze, like the panic, was probably 8 to 12 weeks, and many SaaS companies, have annual renewals, and that protected a lot of folks, right, from panic churn, and so I think a lot of that sort of kept NRR very, very stable. There was definitely a lot of concern, a lot of hand wringing, but I think you're right. It's noisy, but in general, it was actually a relatively good year for SaaS companies.
Yeah, and your 8 to 10, 12 weeks thing is a good comment, because the data question here is January, June, and December, and from our own portfolio, we saw the biggest impacts actually in April and May. And so by June, they'd kind of already started to shift back. Yeah, so I think those are great comments. Thanks, Yuman. All right, so let's look at gross retention though. And so this is interesting, right? It's because you've got, like we just talked about in NRR, you had a little bit of a wash across companies and how they were performing, but then even within a company, their customers might have been impacted differently, right? And with gross retention, where you have that ceiling of 100, I think we're seeing more of a real impact here. So the beneficiaries, you know, they're topped out. You're not getting that same expansion revenue bonus. And so the negative impact of the pandemic and sort of retention and companies churning out shows up here, and I think is meaningful, right? We're seeing more of like a 2 to 3% decline from the start of the year, and I think that's a real number, and that's a meaningful number. And so this chart to me is more useful and feels more real, I guess, if you will. And then to Yuman's point though, like that's still, you know, there were vast swaths of the economy that shut down for months and months and months. Like, you know, I'm talking non-software, right? Like actual restaurants. So in the grand scheme of things, SaaS was and we'll see this in the valuation stuff in a minute, but SaaS was a relatively strong spot for the economy for the year.
You know, one of the things I would probably add to this, Rob, and I also have a question I do want to ask you from the audience. You know, with gross revenue retention, you know, when last March, last April, something that happened, you know, I think SaaS companies reacted very quickly. And one of the things they did was that, you know, it was to basically provide relief for your customers. In other words, like you know, there was definitely that moment, if you remember, it seems so long ago, that we were all in this together. You know, you were not, you know, if you were selling to a restaurant, you weren't going to try to collect, you know, on your monthly payments. So there was a lot of best practices formed around relief. So push out payments, add extra time to contracts, being generous with contractions, mid contract contractions. And I think that blunted a lot of gross revenue retention, right, in the short term. You know, basically, it just kept customers, you know, going for a little bit longer. You didn't churn them through. You may have had contraction, but you didn't churn them. And so, and then maybe once the shock came through, it's like, okay, great, you know, let's continue on, you know, maybe at a lower rate. So we definitely saw a lot of that. You know, before we go on, Carlos had a question about the survey around COVID, and that is, you know, was this survey based mostly on North American businesses, or was this an international survey?
That's a great question. This was actually the first year, Carlos. It's almost like you're not a plant, but I feel like this question was planted. This was the first year that we actually asked geography. We never have before to actually be able to answer that exact thing. And so it's global. It's just out there in the world. We promote it both through our own email, but on social and stuff like that too. And so it's open to anybody. And so it's global. I would say, I'm trying to remember the chart. I don't have it off the top of my head, but something like 2/3 is North America. And I think my colleague Nick is on the phone. Maybe we can pull it up by the end of the time. But the gist is a lot of North American companies, but a lot of international companies as well. A fair number of Australian, a fair number of Indian, UK, and Germany. I think those are all popping out, standing out in my head. But mostly North American, but broad, and Canada too.
That's great. All right.
And
well,
so that's a good. I'll sorry, Yuman, I'll close the loop on that actually, because the question I think is an important one is actually what, you know, the impacts were different and differently timed throughout the year also, right? Is depending on when shutdowns were and when, and like India's now having, you know, its worst spike now, and so yeah, I think maybe Carlos's question is sort of more along that, which is relevant, and so there's probably some of that going on also. And whether you sell, you know, maybe you only sell to companies in California, or you sell globally, or whatever, you know, there's some other totally different business models there.
Yeah, you know, it's interesting. We have a customer called Untapped. They sell to breweries and restaurants, so very beer focused. You know, many of you probably use their app, but they also sell to small businesses. And you know, one of the things they could tell, you know, was when when countries were actually shutting down entire regions. Because using our product, they were able to track usage, and they saw China shutting down, they saw, Australia shutting down, and then they saw the U.S. follow, and so they really got a handle on it, and then vice versa, like who's starting up again, and so this is not an equal. COVID did not hit everyone equally, and they had a lot of insights into that, so I thought that was pretty interesting. All right. Well, hey, let me do a couple things on net revenue retention, and then I'll pass it back to you. There was actually a bunch of questions about how to, the difference between gross revenue retention, net revenue retention. I'm actually going to bring something new in. I'm going to call it logo retention too, just to simplify things. So on the chart, you see net revenue retention. Starting revenue minus churn plus expansion minus contraction. So the only difference between net and gross, so the difference between net and gross is, you do not include expansion or upsell. So that's the difference between net and gross. I also think, CS often talk about something even simpler, which is logo retention, which is, is just a customer count. I have 100 customers, I lose 2. I don't care how big or small they are. I have a 2% churn or 98% logo retention. And what I see is that, CS departments are normally focused on one or the other, right? So as a group, you're either tasked by, your management team or your board to really focus on net revenue retention or logo/gross revenue retention. I'm going to lump those two up in a little bit. And so I want to talk about the implication of those two. So let's move on to the next slide. So let's say, you're a team and you're asked to really focus on net revenue retention. So what does that look like? What's the pluses and minuses of that? Well, because you're focused on net revenue retention, you're going to probably create a lot of tiered experiences for your customers. You're going to segment them, and you're going to say, my biggest customers, right? Because I can probably get them to, when they renew, it's much more meaningful than my tiny customers. And when they expand, it's much more meaningful. You're going to create, sort of your white glove service and then your low touch service. So that's you'll be focused a lot on that. And those of you who are in customer success, you probably know, if this is your metric and this is your bogey, you're going to be creating a lot of that. You're also going to probably focus on product packaging, so you can upsell people, right? So maybe with the bronze package, and then you can upsell them to the silver and the gold. You're always looking for ways for expansion. You're also going to build a more growth-oriented team. So your CS team will not only be customer facing, they'll also be business-oriented. They're there to provide value, but also looking for expansion. Now, sometimes actually, if you totally discard logo retention, so let's say, so I'm going extreme, you don't care at all about logo retention, net revenue retention can actually cause some unnatural behaviors. You can do things like a lot of one-off product enhancements. Oh, big company wants that, of course I will do it, right? Because the big company means so much for net revenue retention. So you'll actually start doing a lot of custom work. You'll find yourself doing that, and that's okay. But too much of that for a SaaS company can really take your eye off the ball. You probably want to go up market right away. It's like, oh, let's go up market, right? Seek the bigger companies that renew better. And then you'll also start forcing yourself to sort of behave more like a Slack and the Zoom, right? Because the Slack and Zoom are the ones who have 130, 140% net revenue retention, and all of a sudden you're trying to figure out how can I be Slack and how can I be Zoom, and you may not have a product that actually behaves that way, and so you start doing unnatural things. There's, by the way, there's a lot of great reasons for being net revenue retention focused. I actually think that's probably the most important metric, but if that's the only thing you think about, it can cause unnatural behaviors.
I think that's a good comment on the concentration, Yuman. Something that we look at so investors, right, are going to look at customer concentration pretty carefully. And so, if you have that really nice 1 or 2 companies that you're focused on and building special modules for and things like that, as long as you can sell those to the other customers, great. But just be very wary of, that revenue creep of those 1 or 2 companies. It could tip you, right? If you start to be 40, 50% concentrated, That's actually a red flag, or at least a yellow flag for investors, right?
Yeah, it's true.
It's a
Yeah, I mean,
great point.
there's definitely pluses and minuses. So, but let's say, you've been told to focus on logo retention, and that's the only thing that matters. And so let's go to the next slide, Corey. So if you are focused on logo retention, you're going to push for a very uniform experience. Like everyone counts the same, right? You can give me $1 million or $1,000. I'm rewarded the same way. So you're going to really push for a uniform experience. There's some pros to that. It's easier to manage, easier to automate. The cons, of course, like, you really ought to be providing your bigger customers a different experience than your smaller customers, right? But actually, if you do focus on logo retention, you're probably also going to focus on interesting things like the product experience, right? Making sure that folks are, really loving the product, because every single customer counts, right, in logo retention. And since every single customer counts, losing any single customer is really tough. What you'll see also, when we see this with our customers, is that retention conversations sort of go beyond customer success and push upstream towards sales and marketing. Like, hey, are you really bringing us great customers, right? There's going to be a focus on the ideal customer profile, the ICP. You hear this a lot. Is the messaging right? Are we bringing all kinds of crazy bad fit customers? So there's a lot of implications, some of them good and some of them bad. In the end, of course, it's generally a balance. You really need to have eyes on both logo retention and net revenue retention.
This was a while ago, Yuman, so now it's kind of standard, like you just said, the sort of standard practice. But I saw the CRO of HubSpot many years ago talk about their realization of that exact last point you made, where they're having high churn in certain areas and they couldn't figure out why. And then he actually, so he's taking some credit here, but he actually sorted churn by sales rep. So not by CS rep, but by sales rep, and saw that there were a couple of salespeople that were just selling completely the wrong customer. And they retrained some of them. Unfortunately, they got rid of some of them, and then retention really improved after that. So yeah, it does definitely moves upstream, messaging to the right target customer and things.
Highly recommended task to actually look at retention by not only rep, you'll be surprised, but also by vertical, or maybe even like I've seen things like marketing channel, right? Like, SEO does great, but like when you pay for it through AdWords, it's horrible. So it's actually can get kind of interesting.
Makes sense. That's great. The only other comment on your last slides were on expansion things that we've seen a lot of our portfolio companies dabbling with usage-based pricing. I think that's it could be its own webinar, so I won't go into more detail there. But there's a lot there that can expand NRR. I know there's even some private equity firms that focus on payments too, like running payments through your platform, and that can expand NRR. So there's lots of other things to keep in mind and think about too. But again, topics for another day, perhaps. Let's keep moving on this one. And you mentioned verticals. So that's one of the ways we did want to split things. So we looked at ACV earlier. One way we wanted to split the survey respondents was by product type, horizontal versus vertical. I'll read you the exact survey question so you know the definition, so you can kind of think of where your company might fit. Does your product serve a vertical industry, i.e. dental offices, auto dealers, or is it an industry agnostic horizontal product, i.e. accounting or human resource software? And so the goal here is, let's split those two things up. One has sort of the horizontal, right, across all types of companies, customers, versus a very vertical niche. And the first thing we see is that in January, so pre-COVID, vertical products tend to have a higher, this is all gross revenue retention, by the way, have a higher gross revenue retention than horizontal products. And that kind of makes some sense, right? You're very focused on a target customer, target persona. You've built your whole marketing, sales, like we just talked about, all the way up, marketing, sales, product to fit that one target customer, and you have high retention. Horizontal is just by its nature going to be solving a solution for a broader range of folks, and you're probably going to have a lower natural retention rate. We see they both were impacted about the same, but the horizontal bounced back quickly and bounced back to pre-COVID levels by the end of the year, whereas vertical was still where it was. And this is gross retention again, so the net effect of companies that were negatively impacted overweighing companies that had, strong retention from their. We're not seeing the total flip from net retention of upsells in a positive industry, right? So I think this is pretty accurate, represents sort of, you're selling to restaurants or brick and mortar retail, and so your retention dipped, right? And not a huge impact. Again, software was pretty resilient, but I think we see it. The numbers speak for themselves here. Okay, let's move on to the next way of splitting things. This is our last slide on the benchmarking data. But median is great. We were looking at median numbers this whole way through, but really when we want to benchmark, we want to know how we compare to the best of the best. So here is bottom quartile, green is median, dark blue is 75th percentile, and the gray is actually the top decile, top 10%, to really see the top tier. And we've got gross retention on the left and net retention on the right. My two big takeaways from these two slides are that gross retention, again, is pretty stable. I mean, 75% of the companies have retention that's pretty solid. And then the bottom 25% is the weaker side. Whereas we see the opposite with net retention, where the top 10% are really outperformers, right? And they're quite a bit higher than all of their peers. And then the last comment for both net and gross is, if you had good retention for both of those metrics, you did pretty well through the pandemic. It didn't impact you that poorly. Median and below were more impacted, sort of 50% of the peers and below. If you had weaker retention, you were more impacted, is what I'm pulling from these two charts. Okay, let's, any comments or questions, we can move on into, so retention is key, like we said at the very beginning, to driving revenue growth and value. So let's talk a little bit about valuations and the impact of retention on valuation. So first, we'll start with the public market. Always good when you're talking about valuation to start with your public comps. And so we have built our own index of about 65 public SaaS companies that we track that look and feel about like the companies that we underwrite. Obviously, they're huge and they're public, but just generally speaking, sort of their metrics and their target market and customer concentration, all those things would be something that would fit our underwriting model. So we compile them into an index, and that's this chart on the left is the median valuation multiple for those companies going back over 10 years now. And this is what we were talking about at the very beginning, is sort of the growth of value. I mean, it's a long bull market, right, since the great financial crisis, and valuations have been steadily rising and then spiked big time, which everyone on this call is probably well aware of, over the last year, public markets at least. We can talk about private markets in a second, but public markets spiked. They have come down a little bit since sort of January, February highs. They'll probably come down even more here by the end of this month when we pull the data again, but still pretty record high 15x ARR at the moment. On the right-hand side, I would love to show you a chart comparing valuation multiple of public companies to retention data, but retention, the SEC nor GAAP require retention data be published, so we don't have it. I went and looked, out of the 65, there's maybe 10 that do publish it, and it's all like well over 150% net retention. So clearly the ones that like to publish it are doing very well and want to flout it. So we don't have a good setup. So anyway, this is growth rate by valuation multiple, and it gives us at least a sense, because we'll show here in a second that net retention and growth rate are pretty closely related. So this is a very nice, direct, positive, obvious correlation between growth rate and valuation multiple from those same public companies. This is the same data set here, public companies, growth rate and valuation multiple. Okay, so let's go to the next slide.
Yeah, by the way, Rob, I have just two comments on that. If you could go back, Corey. So,
yeah, sure.
I wish net revenue retention was a GAAP a metric, right? So GAAP, for those of you who are by the CS side, is a generally accepted accounting principle. So basically everyone defines it and we all do it the same way. Because one of the things about, those high retention rates, not only you're cherry picking a little bit, sometimes like they're calculated differently. And so, or actually I was reading a SEC filing the other day. My life's great, and so I was, and it was somebody who had a very high net revenue retention, but in the footnotes you saw it was for customers with over 500 employees, right?
Oh.
And so, there's a lot of headlining.
So they're looking at retention of their top tier, right?
Of their top
Yeah.
tier, right? Which is okay. It's actually, a great thing to show, right? Because, but it's all to say that without a gap requirement, it's hard to, to do apples to apples comparisons, even for the things that are being, given to the SEC. So let me ask you this question, right? Growth is so value, does anything else matter? Does burn matter? Like, in your own metrics, if you have a high growth rate and a high burn rate, does it matter anymore? Is it all about growth these days?
Yeah, I think that's more of a question for the earlier stage investing. In the public markets, nobody's burning that aggressively. I will say this much. Growth is king. It's definitely the thing. I mean, you see the R squared on this chart. It describes 53% of the of valuation multiple, right? Growth alone
Right.
describes 53% of what drives a valuation multiple. The reason I would say, so most companies, the reason we got to a ARR multiple in the first place is that most SaaS companies were actually unprofitable, whether they were cash flow positive or not, because they would do, a lot of them early on, like Salesforce started this and they went public in 2004, I think, right? They would do annual upfront contracts. So they get all the cash up front and then they've got to defer out 1/12 every month. They amortize the revenue 1/12 every month. Well, they're getting all the cash up front, and then presumably they get new bookings every month, and they keep it rolling that way. But on a P&L basis, that 1/12 revenue, their burn rate is geared towards the full annual contract coming in every month. But on a P&L, they're only getting a little bit of that revenue each month, and their cost structure's geared towards the full thing, so they're negative, right? And so
Right.
price to earnings doesn't work, EBITDA doesn't work. So we've done ARR times revenue, and growth is the name of the game here. So I think early stage certainly matters, especially a year ago when the pandemic hit. There was a pause, especially on high burn. Let's get to break even. We saw in our own portfolio. The cool thing is SaaS companies, you can get to break even if you want. Slow down sales and marketing, and you can get to break even. So it matters. I think there is a turning point where your burn is such that you can't get to break even, and that's the cutoff, right? Is where is that line? And then there's a big difference in potential outcomes for fundraising or for selling on that break point. That makes sense.
Yes.
That was maybe more in detail there, but it's fascinating. It's a fascinating story. It's growth rate and burn. The rule of 40, if you're not familiar, is growth rate plus burn rate. And a private equity investor once said he only invests in companies where that's 40 or higher. And so growth rate, of 40 and 0 burn works, but 20% growth and 10% burn doesn't work. So keeping those things in mind is I think, really interesting way of also thinking about operating your business. Let's quickly, I'll use this chart. I won't go into super detail, but I'll just quickly share. This is actually from the data from the survey. We have growth rate along the bottom and then retention rate along the top. Let's just look at net retention for now. Net revenue retention is correlated positively with growth rate. So I'm sort of turning the corner here between valuation and retention, right? We just saw that growth rate's really important for valuation, and now we're showing that net revenue retention is also very important for growth rate. And so that's the first thing I wanted to show. And it's pretty linear. I mean, it's a little bumpy, but there's that. The one that jumped out at me that I thought was really interesting is if you want to grow more than 40% per year, you have to have net retention over 100%. And I think that's another good target for operating groups to think about, at least from this data set. And then gross revenue retention is a little bit correlated, but it's, again, because it's capped at the top end, it's sort of, and we'll talk about this too, sort of table stakes, sort of you're at 90 or above or not. So let's go to the next slide. This is the one we'll spend a little more time on. So this is data. Did I freeze? I may have frozen.
You are frozen, but we hear you.
Oh, okay. All right.
Yep.
Okay. Can we go to the next slide?
Oh, Rob?
Yeah.
So Rob, you just can you see you're actually at your slide that says insights from SaaS Capital's private B2B
Okay.
SaaS
Yeah,
transactions.
I don't know.
Okay.
I've got a blip in the internet, but I know what it is, so I'll just talk about it. I don't see it, but I'll keep going if you can hear me, which is good. This slide, I'll actually pull it up separately. So this slide is data from our own portfolio. And these are actual portfolio liquidity events, either outright sales or fundraisings over time. So that's the first caveat, is this is going back some odd 7 years or so. So there is a little bit of that. Remember that black slide I showed at the very beginning where valuations have just generally gone up over time. So there's some of that going on. So not totally apples to apples, but this is, kind of best data set that you could get on something like this. And we do have retention data. And so I have shown here, I'm comparing gross retention on the left with valuation multiples from our portfolio, and then growth rate and net revenue retention on the right relative to valuation multiple. So on the left, I would say there's no correlation here, right? There is no line, but if you were to do a trend line, it would be basically pretty flat and horizontal across the whole thing. There's no correlation. So I think this goes back to my comment about table stakes. Either you have decent enough gross revenue retention to fundraise or to get acquired, or you don't. It's a binary thing, right? It's either you have good enough retention to get the deal done, to get a term sheet, or you don't. But then if we look on the right-hand chart, and this is kind of serendipity, I didn't mess with the numbers at all. I think if I ran these numbers, any other time in history, the two trend lines wouldn't line up this perfectly. But it just so happened that when I did this, the growth rate correlation of our private company data and the net revenue retention are almost parallel. But the big takeaway, like our first chart of the public companies, is that net revenue retention and growth rate are both very positive and very highly correlated with multiples that in the real world private companies have attained. Any questions or comments there?
Yeah, so a couple of questions. Maybe I'll bring some in from the audience as well. Sure. Let's maybe focus on your slide on the right where there's a correlation. It's generally well accepted. It's not always true, but like if you're focused on SMB, you're just naturally going to get a lower gross revenue retention, and it'll probably have an impact on your net revenue retention. And so, do you, is the table stakes, or at least is the bar across the same for an SMB, focused company versus an enterprise focused company, or do they, you get the same multiple for two different types of NRR?
Yeah, I think that's a good question. I think I have seen that it's a little bit binary also. There are investors that focus on SMB, and there's others that focus solely on enterprise. Rarely are folks doing both, or even consumer, right? B2C operates very differently. And certainly there's been blowout successes in the SMB side, Shopify, something like that, right? But I think it's harder going, right? We've seen in the data, there's higher churn. And so they just need to be aware of it. And that's why this kind of a thing is helpful, right? It's the benchmarking data that you can compare. And so I think that's something this should empower you as you go fundraise and say, hey, here's my peer group. I'm doing better than my peer group for where I am. My churn might be lower, but it's, relative to my peers of what I do, of what my product is, I'm here.
Yeah. By the way, for those of you on the call who participate in fundraising, my tip to you is if you talk to an investor that doesn't understand the nuances of what you're focused on, was if you're enterprise and you're talking to someone who likes to invest in SMB and vice versa, like those, I say like short circuit the conversation. Don't waste your time, right? Because SMBs from Mars and enterprises from Venus, it's going to be hard for you to actually sync up. So so you're right. I think
I agree with that.
Yeah, people understand themselves very well.
Yeah.
All right, so we moved on to the next slide, I don't know how
Okay.
your setup is. Yep, go ahead.
Yeah. Sorry, I have an internet issues today, of course, during a webinar. Remind me what it's at. I forget now actually what the next slide says. Oh, it's
So
the net
the
retention
waterfall,
ladder, right?
right? Yep.
Yeah.
Yep.
Yeah. Ladder waterfall. Yeah, I love it. So this is just wants to, I just want to make the point here. So we sort of went down the journey of net revenue retention, proving that net revenue retention is really important for valuation, and now kind of want to prove why. And so first and foremost, if you're not only not losing money, losing water out the bucket each month through churn, but you're actually growing the water in the bucket with net revenue retention, positive, or I guess negative churn, right? That increases your growth rate even more. And so that bumps up your growth rate. Even, you can basically, you don't have to sell a new deal and you're still growing. Great. So growth rates are really important for valuation multiple. So that increases your growth rate. And that simply increases your ARR. And that's the thing that the ARR multiple is applied against, right? So those two things are, 90% of your valuation multiple. And so if your valuation dollar. So if you're increasing both of those, you're in great shape. And then we have some ancillary things here, right? We have margins, right? You're able to sell more dollars to the same customer. And so assuming it doesn't cost you a whole lot more to provide those services or whatever it might be, then your gross margin increases, dropping more dollars down to your operating line items for more sales and marketing, more product development, more things that can further increase your business, right? Capital efficiency we've talked about. If you increase retention, you're increasing your lifetime value, and probably lowering your CAC, or through your gross margin augmentation, you can lower your CAC through more sales and marketing or whatever. So capital efficiency is great. It shows, it'll lower your burn, and it shows existing or new potential investors that there is less risk of fundraising down the road. You're not as reliant on new funding coming in shortly, right? Your runway is longer for every dollar that you raise from them today. So they're willing to pay a higher amount there, more stability. And so that all feeds into revenue predictability, which is the name of the game. Value is derived as what is the discounted value of future cash flows, right? And so the more predictable your revenue is, the more predictable we can assume your future cash flows are going to be, and we're more willing to pay for them today. We're willing to pay more for them today.
So Rob, when in your career did you wake up and say, oh, there is a real impact in net revenue retention, and I need to focus on that? Was that a recent phenomenon when you joined SaaS Capital? When did that happen for you?
Yeah, I would say it's a really interesting question. I'd say it's more recent than even joining SaaS Capital. I'd say SaaS Capital's focus as a lender, where we're going to lend you money and we want you to pay us back at some point in the future, we're actually more focused on gross retention, right? Because that's the core sort of what's the base case level of dollars that are going to be sticking around and paying us back, being able to service debt. But about maybe 3-4 years ago, this chart right here really hit home for me. And we've seen it. I just did an interview with one of our most successful CEOs, and he had a huge focus on net revenue retention. And that's when it clicked for me also. And he has done great things with his business and grown it and gotten great value multiples. And so that's watching these things play out in real time. The margin expansion, just all these things you don't think about day to day. That was meaningful. So it's a great question. Day to day, I focus on gross retention. Watching companies succeed and have higher valuation is all about net revenue retention.
And this is probably generally accepted now, you think? Like, will this chart surprise nobody, or is it still, a learning for a lot of folks out there? What do you think?
I bet it's some of these ancillary things may surprise people. I think the growth rate in ARR is pretty well known at this point. Yeah.
The reason I ask is, TurnZero is my fourth company, and I've raised a lot of funding over the years, and maybe 10 years ago, even when revenue retention would come up during due diligence, right? And that sort of is, meeting number 4. And now, we just raised the Series B for TurnZero, and net revenue retention comes up in the first 5 minutes, right?
Mm-hmm.
And so for those of you who, perhaps are in the audience, you're not hearing a lot, I think you will see a groundswell of top-down pressure on this metric, and that's going to come down on you. So in fact, so let's actually go ahead and move on. We're running out of time. I got 2 quick slides for the top things you can do now for both logo retention and revenue retention. We have a lot of sort of master classes on this, so this is actually not that. These are just real quick, for you to get started and thinking about if you're relatively new to customer success. So logo retention, the things I will have you focus on is, one, make sure you're spending enough. In fact, that's probably the one thing, one thing that we see is that people just don't spend any money on CS, and just hopefully that magically that your customers stay. So we see anywhere from 5 to 15% of revenue. It's a very large spread, but it really does depend on what kind of service offering you have. Make sure you're spending enough on CS. Second thing, obsess about onboarding. This affects every account. For SaaS companies, for subscription businesses, any kind of repeat business, your first impression is the most important impression. It's so lasting. Make sure you focus on that. And then, as you get bigger, really process is important. You really want some dependability in how you work with your customers, deliver the customer experience, right? So, at the very highest level, if you're really focused on logo retention, think about these 3 things. All right, how about the next slide? How about if you want to focus on net revenue retention? And so a couple things that you may want to focus on is, one, if you have a customer success team, make sure that they're compensated for growth. Most CS teams that I know, they have a very small bonus pool, make it a little bit more variable, and guess what? You'll see changes in how they behave. So think about comp plans. And then of course you want to tier, right? So when you're really focused on net revenue retention, losing the bigger customers really hurts. So you have to really focus on them a little bit more. And so focus on usage engagement, make sure they're sticky. And you'll have to tier your base, and then also invest in data. So look, I'm a data person, I'm a process person. I think you actually invest in data and process in both of these, but data is actually even more important with net revenue retention, because you need to know when to ask them for things, right? You need to know, is it time to ask them for an upsell, an expansion or whatnot. So the data is going to be super important. So anyway, some top tips. Yes.
Yeah, that's awesome. I've got a little, we have a whole nother section of our survey we do on spending. So I thought I'd augment your first bullet here. The median spending is 11% of revenue in CS. And we found that companies that there's kind of a direct correlation between growth rate and, so I'm reading off of some data. My internet is still super wacky. Sorry about that. That's what I'm doing here. The companies that are that spend less than the median tend to grow slower than those that spend more, and particularly true in the top and bottom quartile of spending. And so the bottom quartile of spending, companies are growing about 28% year over year, whereas the top quartile they're spending more than 18% of their revenue in CS, and they're growing at 38% a year.
That is, if you feel that you're underselling or underspending, if your company is underspending in CS, just take that snippet, right? Just go ahead and you'll get a recording of this. Write that down because it pays off, right? I mean, what Rob just said is that investment in CS will pay off in growth, and value. And I think that and value, and that's and many years of data. All right, so let me actually turn to questions from the audience. And by the way, Nick, your colleague Nick, did put in a couple of metrics. So I'll repeat this. 40 countries responded to your survey. So companies from 40 different countries. And the top countries were the US, Canada, UK, Australia, and New Zealand. Basically all over the place. And please go ahead and answer questions, ask questions in the question box. So one actually, once again, you said you could actually do a whole webinar on this, but there were questions about usage-based metrics, right? So how does how do you calculate net revenue renewal there, right? Like if it's just usage based and it goes up or goes down based on usage, do you still depend on net revenue retention in those business models?
I would like for both of us to answer this question. I think we might have different approaches to it.
Mhm.
We tend to not underwrite businesses that are heavily usage based because it's a little more volatile. So the cool thing is there's tremendous upside. The slightly nerve-wracking thing from our perspective as an investor, as a lender, is there's also downside, right? If they stop using it, depending on what the metric is that it's based on, if they, I don't have anything off the top of my head, but it's just more volatile. And so we have done lots of deals with companies that have a base license rate, and then they have a usage sort of bonus on top of it, and that's fine. But we lend off of and we track the retention of the core licenses. It's too messy for us and a little bit too far afield for us to get deep into the usage. So I'd be curious if you have customers that are doing heavy usage, or how that.
Yeah, we do, and look, I mean, in the end, how you service them actually is not much different, right? They still have to be on board, they still have to love your product, they have to still use your product. It just so happens they're paying for usage rather than paying for access, if you will, or subscription.
Yeah.
I still think that revenue retention works really well, right? Because if unless you have a seasonal product, so I'll take that aside. Seasonal products are actually kind of tough. If you're a successful company, you would imagine that overall your customer base not only should be growing, but should be using more and more your product, right? And so, in general, if you just basically say, I have 100 customers, in November, they gave us this much money, in December they gave us that much money. It feels like a net revenue retention. So I think you can actually do it. It may be not exactly net revenue retention, but I think it feels the same. So I think is also quite good. A question from Giovanni, I think is a great question, actually. So when we talk about percentage spend for CS, okay, Bob, you said 11% is the median in is that 11% of accounting revenue? So basically, or is it 11% of expenses, total expenses? Like what's the 11% of?
Yeah, that's a good question. In the survey, we ask of revenue, and so it's an annual number. Yeah, so it's based on revenue, which it would. Our assumption is it's P&L revenue, so not bookings based. That would be sort of splitting hairs, but I think ARR, is a good easy answer.
Got it. Okay.
So I missed a key point when I said so. The 11% is the median. Bottom quartile is 7% or less in my data that I gave you a minute ago, and then, like I said, 18% is the top end, the top quartile. So anything 18%. Under 7%. Yeah.
Okay.
So those are your ranges: 7, 11, 18.
Fair enough. All right. So a lot of people wanting you to predict what the market's going to be like in the next 12 months. So I'm going to give you a shot at that. Like, is SaaS, in terms of multiples, is it going to go up, go down, sideways over the next 12 months? There's a whole bunch of questions about that.
Yeah, we're already seeing some come down. Zoom is already down significantly, even though it's still growing 300%, because its growth will slow. It already is sort of on a quarter-over-quarter basis, and its annual year-over-year hasn't caught up yet because it's still based on very small numbers from Q2 of last year. So I think we will see multiples come down, but at the same time, we are seeing private multiples finally catch up a little bit. So private multiples as of Q3, Q4 last year were still in that historic median. I didn't show this slide. It was a slide I made, so you don't know what I'm talking about. But median range for private companies has been 3 to 6 times ARR for the last 10 years or so, gradually tipping up a little bit. And now we're seeing numerous companies price 8 to 12. And so it's definitely jumped up a little bit. I think that will come to, so public multiples will come down faster, but I think private multiples will come down a little bit as well. It's tough for a private equity investor. Public investors are sort of a separate animal, and I can't speak too much to that. But a private equity investor is going to have a hard time when their fund life is 8 years. buying a company for more than their fund length of time worth of revenue, right? Unless they're looking for massive growth there. And so unless, I think we're assuming growth rates will slow a little bit after the pandemic. And so I think things will come down a little bit, but still I think SaaS and software is a very bright spot for a long time to come. But
all right, so
exuberance is over.
Yeah, there's some sanity that you are assuming there, Rob, that I'm not sure is happening. But all right,
yeah, I mean, inflation and all the extra money and all that, that's real. I think there's real money out there. We've heard about it: lumber, housing markets, commodities. Everybody's looking for a place to put money, and so SaaS companies are successful. But I think we've hit the top for now.
So I'm going to end there with Rob suggesting that we put all our money in lumber, and I'm going to pass this back to Corey. We have a lot of questions, but I think we answer a lot of them in the blog post, right? Perhaps if there's enough, Corey. But I'll pass it over to you right now.
Yeah, thanks so much, Rob and Yuman, for sharing those insights. I just want to remind everyone, again, we are recording this session, so we'll be sending out a follow-up email tomorrow with a link to the recording and a PDF of the slides that you can view all this again. And at the end of this webcast, a survey will pop up. We'd really appreciate it if you could just take a moment to provide your feedback on today's webinar. So stay tuned for more webinars from us, and we look forward to seeing the results that you'll share with us again next year, Rob. And thank you everyone for joining us.
All right, thanks everyone. Bye-bye.
Always great. Thanks so much. Take care.
Okay, bye.